Ever feel like, I don't know, your bank account balance or maybe the price of milk is on some crazy roller coaster? And it's guided by bankers like halfway across the world.
Yeah, you're definitely not alone there. It often feels that way.
Welcome back to the Deep Dive. Today, we're cracking open a really fascinating stack of information. Try to connect those distant dots to your everyday life.
We're diving deep into the Consumers.App news aggregator. Specifically, we've pulled apart their Consumers360 News Commentary from June 3, 2025.
Right.
And what's great about this commentary is pulls together insights from, a whole bunch of different sources, articles, research, data, giving us a real snapshot of what's hitting consumers and economies like right now.
Exactly. So our mission today is to take that raw material, these key headlines, the analysis that Consumers.App provides, and figure out the important takeaways. What are the essential nuggets? What does it really mean for you?
Think of us as guides, yeah. Helping you see the forest and the trees and all this information.
Perfect way to put it. All right, let's kick things off. Big piece of economic news coming out of Australia.
Yeah, this headline is from ABC. It really caught our eye. GDP numbers argue for more RBA interest rate cuts as savings rise and spending flatlines.
Okay, so the RBA, that's the Reserve Bank of Australia, they're clearly feeling the pressure. The Consumers.App research really gets into the context here. They did recently cut their main interest rate, the cash rate, back in May 2025. Just a small cut, 25 basis points, bringing it down to 3.85%.
Right, and that was actually their first cut since January of that year. But it's crucial to remember the lead up, isn't it?
Yeah, definitely.
They had significantly raised rates all through 2023, got up to 4.35% by November 2023. So this May cut was, a shift after quite a period of tightening.
And the why seems pretty clear from the data. The research points out that Australia's GDP per person actually fell throughout 2023.
Which sparked all that talk about a per capita recession.
Exactly. So even if the whole economy was maybe growing a tiny bit, the output per person was shrinking.
And that per capita number, that's really significant. It hits living standards directly, individual spending power. So the RBA's recent cut is an attempt to, stimulate things.
But the research suggests growth and consumption are still, pretty sluggish as of mid-2025.
Yeah, it's slow going.
What really stood out to me in the report was this point about household savings. Higher interest rates make borrowing costlier, sure, but they also make saving look more attractive.
Right.
And the research suggests Australians actually built up quite a buffer of savings, and those savings are now playing this crucial role.
Cushioning the blow, basically.
Yeah, they're helping soften the impact of those higher rates, maybe preventing a total collapse in discretionary spending, which might have been different from what we saw, say, late in 2023.
That's a really key nuance. It means the impact of monetary policy. It's not just about borrowing costs. It's also shaped by what households actually have saved up.
So how does this RBA policy, how does it translate to, the shops, retail spending?
Well, high rates generally hit the brakes on borrowing, right? So that can slow down retail sales. And even with the RBA's recent cuts, the research notes that other things like ongoing worries about inflation, just the broader economic mood, are still keeping retail spending pretty constrained down there. Turnover actually fell by 2.7% in some periods mentioned.
So it's not just a simple lever they pull.
No, not at all. And the scholarly research cited by Consumers.App points this out too. Rate adjustments might offer some short-term relief, but how effective they are long-term, that really depends on global factors, government spending, tax policies. It's a whole mix.
Complex dance, as you said.
Exactly. The RBA's main job, historically, is managing inflation. They target 2-3% in employment. But balancing those goals when the global situation is so uncertain, that's tougher than ever.
And the report mentions those global factors too, doesn't it? Things like trade, geopolitical tensions, risk of global recession.
Yeah.
All feeding into the RBA's thinking.
Absolutely. So the takeaway here, even if you're not living in Australia, is just seeing how incredibly intricate that central bank balancing act is.
Yeah.
They're juggling inflation, growth, savings habits, spending, all while these unpredictable global forces are swirling around. It just shows how these big, distant decisions can have really complicated ripple effects on everyday life.
Okay, so moving from one major economy, Australia, let's hop over to India. Some really interesting shifts happening in their banking sector.
Yeah, this next headline is from Reuters, gets straight to the point. India considers easing bank ownership rules as foreign interest grows.
Easing ownership rules.
Okay.
Right? Sounds like they might be opening the doors a bit wider. What exactly is the Indian banking regulator thinking about based on the research?
Well, the report indicates they're looking at making it easier for foreign companies, foreign entities, to own a bigger slice of Indian banks.
Why now?
Seems like two things. One, foreign institutions are apparently quite eager, showing a real appetite for acquisitions in India's growing market. And two, India itself needs a lot of long-term capital to fund its economic expansion.
So this could mean changing the current limits on how much foreigners can own, their voting rights, that sort of thing.
Potentially, yeah. Tweaking those rules seems to be on the table.
And we've seen signs of that foreign interest already, right?
Oh, definitely. The research flags a huge $1.58 billion deal involving Yes Bank, apparently the largest cross-border deal ever in India's financial sector.
Wow.
And there's also competition for a big 60% stake in IDBI Bank with global players like Fairfax Holdings, Emirates, NBD. They're all in the mix. It really shows the demand is there.
So the big question then is, what are the potential upsides and downsides of letting more foreign money into such a key sector?
Good question. On the plus side, the research suggests, it could bring in much needed capital. It could foster global partnerships, maybe bring in more efficient banking practices.
But the challenge...
Well, navigating the existing regulations is one. There are also potential concerns about, keeping local control and making sure that foreign influence doesn't somehow compromise domestic financial stability. It's another one of those balancing acts, isn't it?
Just like the central banks. And for context, the report mentions that while India's overall foreign direct investment, FDI, it dropped in 2023.
Yeah, down 43%, though global flows fell too.
Right. But even with that drop, India is still a major destination for foreign capital. It was the 8th largest globally, attracting significant investment in new projects, big finance deals.
And the Reserve Bank of India, the RBI, different central bank, same initials as Australia's RBA. They're key here.
They're the ones making the call.
Exactly. They're reviewing and potentially revising these ownership rules. And the research points out the RBI has actually shown some flexibility already. They seem more willing to grant exemptions case by case, which suggests, an openness to accommodating foreign investment.
Okay, so pulling it together, what does this signal for India's banking sector if these changes go through?
Could be pretty significant. Potentially a big influx of foreign investment. More competition between banks, maybe improved efficiency, definitely more capital available for lending and growth.
And maybe aligning more with international standards.
Yeah, better alignment with international banking practices, maybe even modernization of the sector's infrastructure. Lots of potential impacts.
So why should you, the listener, care about this?
Well, when a major global economy like India considers opening up a core sector like banking, it sends ripples everywhere. It could influence where global capital flows. It could change the competitive landscape for financial services globally. And it really shapes how such a massive economy plugs into the world's financial system. It's a strategic move driven by need, but with complex outcomes.
Okay, right. Let's check in with Canada now. See what their central bank, the Bank of Canada, or BOC, is up to with interest rates. We've had Australia cutting, India maybe opening up banking. Where's Canada sitting?
The headline here is from Seeking Alpha, giving us the outlook. Interest rate outlook. What to expect from the Bank of Canada.
And the Consumers.App research tells us their latest move.
As of June 4, 2025, they held their main rate, the overnight rate, steady at 2.75%.
Held steady. Okay.
But what's really interesting here, and this is key context, is why they held steady. Unlike Australia, who just recently started cutting, the BOC had actually been cutting rates before this decision.
Oh, right.
Yeah, the research points out they've cut by a pretty substantial 225 basis points. That's 2.25 percentage points since June 2024. So this decision to hold is not about whether to ease. It's more about pausing. See what those previous cuts have actually done.
Ah, okay. So they've already put stimulus into the system, and now they're sort of assessing the impact. The report says they're balancing inflation control with supporting growth.
Exactly. They've seen some stronger GDP growth recently, which is good, but also some sticky core inflation. That seems to be why they decided to, just hold tight for now.
It's a cautious approach then, after a fair bit of easing.
Precisely. And the research also brings up the impact of Basel III reforms and all this. Those are the global banking rules, stricter capital, and liquidity requirements for banks.
Right. How do those stricter rules play into interest rates or lending?
Well, the research suggests Basel III tends to put a bit of upward pressure on market interest rates generally. Might widen the gap between what banks borrow at and lend at, And it can also reduce lending to the private sector a bit, simply because it becomes more expensive for banks to extend credit under these tighter rules.
So holding rates steady after those earlier cuts is the BAVC's way of trying to navigate all this, trying to keep inflation tamped down while letting the past stimulus work, but also knowing their previous rate hikes are still out there slowing things down.
That seems to be the idea. And some research mentioned in the report suggests that these traditional tools, like just tweaking rates, might be a bit less powerful when banks have other issues, like funding problems or maturity mismatches.
Like borrowing short-term to fund long-term loans.
Exactly. That can create frictions that sort of blunts the impact of what the central bank is trying to do.
And the BSC's overall job, of course, is central here, setting monetary policy, keeping the system stable, managing inflation and growth, using rates as their main tool.
Right. So their recent decision to hold steady, it fits with a strategy of monitoring. Watching how the economy is absorbing those big rate cuts from the past year while still keeping a very close eye on inflation that hasn't quite gone away.
So what does keeping the rate at this level mean for, say, Canadian consumers?
Well, keeping it steady rather than hiking it again creates a more stable borrowing environment, right? It avoids immediate jumps in costs for things like variable rate mortgages or lines of credit.
Which could help support spending.
Potentially, yeah. Helps support consumer spending, which is vital for growth without maybe pushing people into taking on too much debt. It's that constant, delicate balance. Encourage activity, but don't let things overheat.
Okay, now let's completely pivot. Switzerland, where the economic story is heading in a very different direction compared to places still fighting inflation.
Yeah, this headline is quite something. It's from Reuters via MSN.com. Swiss inflation turns negative, raising likelihood of negative interest rates.
Negative inflation. Deflation. Wow. That's a term we haven't heard much lately in many big economies.
Not so much, no. The Consumers.App research confirms it. In May 2025, Swiss consumer prices actually fell by 0.1% compared to the year before. First time they've seen deflation since March 2021.
What on earth caused that turnaround?
The main drivers seem pretty clear from the report. A big one is the strength of the Swiss franc. It's seen as a safe haven currency, so it's strong.
And when it gets stronger, imports get cheaper.
Exactly. Imports are a big chunk, 23% of their inflation measure. And import prices fell 2.4%. The other major factor was falling global energy prices, down 8.3%.
So strong currency, cheaper imports, cheaper energy, pulling prices down. And this negative inflation makes it more likely the Swiss National Bank, the SNB, cuts rates potentially below zero.
That's the thinking, yes. As of early June 2025, the financial markets are pricing in a pretty high chance, 69%, that the SNB will cut its main rate from 0.25% down to zero.
But maybe even lower.
Yeah. There's also a notable chance, mentioned 31%, that they could go back into negative territory, maybe cut to minus 0.25%. They were last negative back in 2022.
That's strong Swiss franc. It sounds like a bit of a double-edged sword then. Good for keeping import prices low, but maybe a real headache for the SNB if they're trying to avoid deflation.
It's definitely a major factor driving that deflationary pressure, especially this year. And that negative 0.1% inflation rate, it's clearly below the SNB's target range of 0% to 2%.
So being below zero really puts pressure on them.
Huge pressure to consider easing policy further, hence all the market talk about negative rates.
What specific things are dragging prices down the most, besides imports and energy?
The research lists imported goods, negative 2.4%, energy, negative 8.3%, and also administered prices, negative 0.7% is the key drivers. Things like transport, food, household goods also saw some declines.
But not everything.
No, it's worth noting, services inflation and core inflation, which strips out volatile stuff like food and energy, they're still positive.
Yes.
At 1.1% and 0.5% respectively. So still positive, but quite low.
Is this sort of thing common for Switzerland? Does the report give any historical context?
It does, yeah. Switzerland has actually faced deflation before. During the pandemic, for sure, but also between 2014 and 2016. In fact, the report notes Swiss inflation has been negative for roughly a third of the time since 2009.
Wow, so struggling with low inflation or deflation is kind of an ongoing theme for them.
It seems to be, yes.
Yeah.
Unlike many other advanced economies right now, wrestling with high inflation.
So if this SMB does go back to negative rates, what are the sort of broader economic implications?
Well, the report outlines a few possibilities. It could potentially weaken the franc a bit, which would make their exports cheaper and imports pricier that might help fight deflation. It would also make borrowing even cheaper, which could stimulate the economy.
But there must be downsides too.
Oh, yeah. Negative rates can squeeze bank profits. They can encourage capital to flow out of the country looking for better returns elsewhere. And they make life really difficult for savers and pension funds. Equity markets might like the cheap money, but the move itself really highlights those persistent deflation risks they face.
It really is a fascinating contrast, isn't it, to the stories in Australia and Canada dealing with inflation pressures. Shows how different factors, currency strength, import reliance, energy prices, can push an economy a totally different way.
Absolutely, and forces central banks to consider pretty unconventional tools like negative rates. It really highlights the diverse range of challenges central banks are facing globally right now.
Okay, right. Let's shift gears completely now. Away from finance and central banks, let's talk about actually moving physical stuff around the world. Supply chains.
Yeah, this final headline, it's from Forbes, and it really nails a critical challenge. Supply chain leaders face the Cost V's Resilience Balancing Act.
That sounds exactly like the core tension, doesn't it? Especially after all the disruptions we've seen over the last few years. Companies want to be lean and low cost, but they also absolutely cannot afford to be crippled by the next shock.
That's precisely it. And the Consumers.App research, citing findings from the National Association of Manufacturers, confirms that this is a massive focus. Get this, 86.2% of companies are actively restructuring their supply chains, specifically to de-risk and build resilience.
So it's not just talk, they're actually doing it.
Seems so. They're apparently integrating these resilience goals right into their performance targets. It's not just some side project anymore.
Where does technology fit into this balancing act?
Technology is huge here. The report highlights the role of AIoT, that's the artificial intelligence of things. Using AI combined with all those connected devices and sensors can really boost resilience.
How so?
Well, the studies mentioned show AIoT helps companies manage uncertainty, react to sudden changes better, improves decision-making, and basically keeps operations running even when disruptions hit.
And what about the academic side? Is research backing this push for resilience?
Yes, definitely. Recent academic work cited emphasizes integrating not just resilience, the ability to bounce back, but also robustness, which is more about withstanding the initial hit.
Okay.
There was a study mentioned focusing on West Africa, for instance, that developed a regional risk framework. It showed that really balancing costs and resilience effectively requires a deep understanding of the specific regional risks and also how demand might behave during a crisis.
It feels like the pandemic was the big wake-up call for all this.
Without a doubt.
Yeah.
The research confirms COVID-19 forced a lot of hands. Many organizations significantly ramped up their resilience efforts right afterwards.
Is that momentum continuing?
Well, the 2023 BCI Supply Chain Resilience Report, cited in the research, suggests maybe some of that initial urgency is fading a bit. But crucially, it also notes that supply chains are, overall, still stronger now than they were before the pandemic. The takeaway seems to be that keeping that strength requires ongoing commitment.
And then there's sustainability, right? Does that add another layer of complexity to this balancing act?
Oh, absolutely. The research touches on this, trying to integrate sustainability goals, environmental, social into supply chain design adds yet another critical factor that leaders have to juggle alongside cost and resilience. Finding ways to be responsible without compromising their ability to handle shocks or keep costs manageable for you, the consumer. It's tough.
So if you boil it down, what are the key ingredients of a resilient supply chain, according to the research?
Based on the studies cited, it seems to come down to a few core things. Having really effective risk management strategies in place, robust infrastructure, both physical and digital, and the ability to be adaptive to deploy new strategies quickly when things go sideways.
Like that Africa study you mentioned.
Yeah, that pointed to things like doing detailed regional risk assessments and using sophisticated models to predict and handle sudden changes in demand.
And how does digital technology specifically help with managing the risks?
Digital tech is seen as absolutely pivotal. Though, interestingly, a 2023 survey cited in the report highlights a bit of a gap. Only about a third of leaders said they prioritize resilience when making tech investments.
But they know they need it.
Seems so. 86% agreed they need more tech investments specifically for risk management. Technologies like AI, IoT. They're crucial for spotting risks early, tracking them in real time, figuring out how to mitigate their impact, and just making the whole chain more agile and responsive.
So what does this deep dive into supply chains mean for you listening at home? These chains might feel distant, maybe invisible most of the time.
Until something goes wrong.
Exactly. But they directly impact whether the products you want are actually on the shelf, how much they cost, and how reliably they get there. This research shows that companies are trying to learn from the really hard lessons of recent years.
They're actively working to build systems that aren't just efficient on a good day, but are also tough enough to handle the unexpected bumps in the road, trying to strike that incredibly tricky balance between keeping costs down for everyone and making sure things actually get to where they need to go.
And that pretty much wraps up our journey for today. Wow, we covered a lot of ground.
We really did. From the very different challenges facing central banks, Australia, Canada, Switzerland, dealing with inflation, deflation, policy effects,
to the potential for big shifts in India's banking sector due to foreign investment.
And finally, that critical strategic balancing act happening right now in global supply chains, focusing on resilience.
So you've just absorbed key insights across a whole range of global economic and business topics, all distilled from that recent Consumers.App news aggregation and their Consumers360 commentary.
Hopefully giving you a pretty solid understanding of some complex forces shaping our world right now.
Thank you so much for joining us for this deep dive. We hope it gave you some valuable perspective.
Yeah, thanks for tuning in.
Before you go, though, here's a final thought to maybe mull over. We've seen central banks wrestling with global factors they can't fully control, companies reacting to global supply shocks. Given how incredibly intertwined everything is now, is it really realistic anymore for any single country, any single central bank, to completely control its own economies? Or are they increasingly just, passengers trying to steer through these much larger global waves?
Definitely something to think about.
Food for thought indeed. Please like and subscribe to Consumer360 for more deep dives into the news and research that impacts consumers like you all around the world.